Good morning, everyone. Welcome to this update for global stocks and commodities. And if you've been reading any of the local press, you will be aware that the Australian economy is travelling far from well at the moment. There is a lot of issues, and we've finally got the RBA acknowledging that things are nowhere near as good as they've been saying they were. So this week I want to look at the concept of how do we gain a large edge on a market when the big picture backdrop, the environment is pretty weak, and you'd be a brave person to say that we're not at some risk of falling into recession after 28 consecutive years. So that's what the focus is for this week. I want to look at the shorter term outlook, both the fundamentals and the technical aspect of that, and also put some light on how to go about finding stocks that have got highly reliable growth at a good rate. So they're going to be significantly higher in a year or two's time than where they are now, but have got relatively low short-term downside. Now that's the ideal, and I spend a lot of time trying to find those sort of stocks, and I've certainly got a bunch of them in Australia. So I'm really excited about the opportunities in Australia, but they're extremely limited, and you've really got to do your homework to find them. Portfolio Analyst last week, I put a lot of focus on tactics. Tactics are just as important as stock selection. So how you get into a stock, how you take profit, how you manage the trade while you're in there, all those sort of things are really important. And I also reviewed my high conviction local stocks as well. So it was a good session last week. Now, the current influences in the market, there's a lot of there's a lot of short-term signals out there that could be construed as negative, and they tend to push the market around in the short term. So let's just touch on a few of them. The Eurozone is in trouble. I don't think there's any question about that. The growth forecast is down to just 1.1%, which is amazing considering what they've thrown at that economy or those group of economies over the last decade. They've been unable to move rates up, so the ECB hasn't been able to do what the Fed did and raise rates and reduce the size of their balance sheet. They've had to introduce more stimulus, and all that just shows that how fragile the European economies are, and we've already got a couple of economies heading into technical recession. Now, I'm bullish on China over the longer term, and this is only one data point, but the exports in February did plunge by 20%, which really spooked the China market, and there was about a 4.5% drop last week, despite the fact that China market had probably gained 20-25% in the last couple of months. And in Australia, we've really got a perfect storm of factors brewing here, and they're almost exclusively negative. We've got high debt at all levels, particularly at the consumer level. We've had weak wage growth for many years now. We've now got the RBA acknowledging that we've got a stalling economy. We've got very weak credit conditions. We've obviously got a declining property market that everybody knows about. And I'll throw in one of my pet hates, and that's just hopeless leadership, particularly at the political level on all sides, but also to a degree at the corporate level as well. I don't believe we have anywhere near the quality of leadership that we should have. So a lot of negatives in the Australian market, and I'll come back and address that shortly. Now, the American stocks, the S&P dropped by 2.2% for the week. This was a very predictable pullback. We'd had 9 weeks out of 10 closing higher, and we'd hit resistance. So, the fact that we got a pullback was almost a no-brainer. But human nature being what it is, people want to assign a reason. We don't feel comfortable unless we can assign a reason for why things happened. Just sometimes the market just goes down. More people sell than buy, and you don't need to really explore it too much further than that. But those who are eager to assign a reason found plenty of ammunition, and certainly some of those factors were on the previous slide. In the US economy, I believe the valuations are about right. You could argue that the American market could go slightly higher or slightly lower based on fundamental valuation, but it's about right. And the economy, yes, there's some issues, particularly around the housing market is probably the most notable. And of course, there's the massive government debt situation, but that's a long-term issue. But from my perspective, the economy is good enough. It's good enough to allow corporates to grow their businesses the way they want to, and it's good enough to sustain the earnings that underpin the current valuations. So I'm not particularly perturbed about the US market at all in the medium to longer term. So buying the dips remains a valid stance for me, both on fundamental grounds. So that's the fundamental health of the economy, the fundamental health of the companies, and the valuations, but also on a technical basis. There's just really no signs that that we've got an emerging technical situation that looks nasty. Frankly, I just don't see it. The US dollar moved fairly strongly higher last week, finished quite well on Friday, and the 10-year yield fell back from around 2.75 down to 2.63. So that's reflecting the fact that the Fed has, really put the brakes on the interest rate hike situation. So let's jump in and take a look at the S&P. So here's our 10 weeks pretty much straight up from Christmas Eve. We got up to the 2800 level. These are all levels that I had last week. And we've got other key levels, which is the peak here formed when we got that real blow-off top in January of 2018. So that comes in at around 2870. And then, of course, we've got the all-time highs at roughly 2950. So we had a big run up, and we've had a bit of a pullback. But you can see there was a gap down on Friday. That was really in response to that China data. But the market turned around readily enough and finished on its highs. It finished down on Friday, but it finished on the high of the session. So there's nothing there that suggests to me anything untoward. This is a perfectly normal pausing around key resistance. And I think personally that we're going to chop around here between, we could go a little bit lower. And last week I put up a Fibonacci retracement, which if we are in a strong, relatively strong environment, then we really shouldn't go below the 38.2, which gives us some further latitude. We could come down here to 2650 yet, and that would be still absolutely fine in terms of the uptrend. The big picture trend would still be intact. So anywhere between 2630 and 2900, I think this market is going to bounce around, and probably in a fairly volatile fashion for maybe many months. And I know I've mentioned it before, but in this sort of environment, writing option premium is just an excellent risk-reward way to go about it. So that's the US market. The Nasdaq and the Russell looked fairly similar, and the Dow Jones, not a lot of change. All the indices are going pretty much together. The market breadth is very good. That's a really important indicator. The fact that we've got so much breadth in the market. You can see things here that you want to see. If you've got a bit of a bearish outlook, you can look at this chart and construe that it's bearish. But when you look at the breadth of the market, it's telling you something different. The market is clearly saying it's being very well supported across the board. This is not just the FANG stocks and some other major stocks that are holding the index up and everything else is crumbling underneath. That is not this market at all. US dollar, DXY, so we're back to the short and medium term highs around 97.5, so that all looks fairly good there. Now the Australian dollar is took a bit of a hit, and we almost broke 70 through the week on Thursday. and we're right back down the bottom. We're in a general distribution range, and I believe the odds are, there's not a guarantee, but the odds are that it's just a matter of time before the Australian dollar breaks 70 and heads on a renewed downtrend to the downside. So let's look at Aussie stocks. The Australian dollar down to 70.4. There was a little bit of a bounce on Friday, and what we've seen is a real roller coaster in the currency around our jobs data, which tended to push the dollar up. And then we got calls from various sources, in particular from Westpac, calling for 2 rate cuts. And we've got more and more economists now starting to jump on that bandwagon. So that sent the Australian dollar down. And then, of course, we've got this ban on coal imports, and there was a little bit more substance to that through the week. And of course, coal is such a vital export for Australia, and that that sent the Australian dollar down to about 70.05 at one stage. So a real roller coaster for our dollar. The ASX index, we managed to rise by 10 on the week, but our economic growth is slowing, and it's slowing sharply. In the last year, we've gone from projections of 4% growth, and we're now down to 1% growth. It's been a meteoric fall in terms of the growth outlook. So that's really not a good sign. So really, that brings us to the point about what investments to focus on when you've got that sort of environment, when you've got the possibility that after 28 years, the Australian economy is going to fall into a recession. Now, during that 28 years of expansion, the Australian market has hardly kept pace with the US and many other places around the world. So how's our stock market in general going to go if we do happen to fall into a recession, which, I think you'd be very brave to say is not some sort of possibility. So, as I said, I'm in a position where I do get feedback from lots of people, the odd phone call, and certainly plenty of emails. And the message that I hear from people is, what can you do if you don't have enough saved and you just can't afford another 20% plus drawdown in your savings? And I find that most people are confused. They don't have much idea about how to generate the sort of return that they absolutely need to get while still protecting the value of their savings. So that's the message that I get back from investors out there. So what I'm going to do, and I do this very, very rarely. I think the last time I did this was probably 2 years ago or more. But I'm going to produce a video in the next couple of days. It'll be out during the week. And what I want to do in that, because I think this is such an important point where the Australian economy and the Australian stock market is at, that I want to give you some insights into investments that I expect are going to do very well, even in a very weak local economy. So that's my base assumption, that things here are going to be unpleasant, they're going to be difficult, and as a result, every investment I look at in Australia is being looked at through that lens, that we've got a really unfortunate background. What I want to do, and this is just so important, what I want to do is give investors the confidence to get on with it. If you know where the really good investments are, the second part that you need, because we are our worst we are our own worst enemies, is that you've got to have the confidence to pull the trigger. It's one thing to find or be given opportunities that are going to do extremely well, but so many people that I communicate with are just really nervous about pulling the trigger. So you've got to have the confidence to get on with it, and I want to try and contribute to that if I can. We tend to miss so many opportunities because of just fear about the market. Will the next correction, is that just around the corner? About confusion, about just hesitation to pull the trigger, and it's often others seem to be on these really good long-term winners, but we find out about those long-term winners when they've already gone up 3 or 4-fold, and we sort of feel like it's too late. So, I understand all those emotions because, I used to be there as well. So this video will be about having greater clarity about the path forward, and I think that's a huge bonus. Confidence and clarity about what you're doing, because what it will do, it will allow you to grab opportunities as they present with less hesitation. So it'll help prevent you straying from your game plan when things get volatile and things get unstable, because then you start to second guess what you're doing. Anyway, and enough of that. So that'll be coming through the week. So look out for it. It'll be I'll be doing a full fundamental and technical analysis on a couple of local stocks that I have very high expectations for. And as I said at the start, in fairness to paying members, I only do this maybe once every couple of years, because it's just not right to be providing that for free. But look, always there's the $1 portfolio analyst trial opportunity, and that's always there. So if you haven't tried portfolio analyst, I think you'll find an enormous amount of education and tactical information. Even if you don't end up staying and being a member, I think you get a lot of benefit just by taking that trial. So that's enough on that. That'll be coming out during the week. Let's just look quickly at the Australian market. So we had a good rise. The market did pull back fairly sharply on Friday, as you can see, and again that was in response to that data out of China. But we were overbought. We'd been overbought since early February, so no real surprise that we get that sort of pullback. So it'll be interesting to see what happens here on Monday. So that's the Australian market. Now, while I'm here, let's just look at gold. You can see quite a nice move up. We continued to dribble down a bit during the week. We got down to 1280, and then quite a nice turnaround, finished at 1298 on Friday. So that's the daily chart. Clearly, we've still got higher highs and higher lows with gold. So looked at on the daily chart. On the weekly, we've still got to get above this 1380 level is the key. And I think that'll really get things firing up in the gold market. And this is GDX on a weekly basis, so you can see it was an upward week for gold stocks, overseas gold stocks. The Australian gold stocks producers did tend to pull back a little bit during the week. Oh, and just on Australia, the investments that I'm talking about here, there's hardly any of these ones that are in the top 100. And let me just put a little bit more flavour to this. Sorry, I forgot I had this slide. So this is in general the process that I go through in terms of finding good Aussie stocks that have got the ability to grow very substantially over the next 1 to 2 years. But there's also limited sort of downside. And these aren't microcaps. So microcaps are a different kettle of fish altogether, because they can move around 10, 20, 30% in a day or two. And they're unpalatable for most people unless you hold a very, very small position. So I'm not talking about the massive growth potential of microcap stocks. I'm talking about really solid, established businesses. Most of them will be somewhere close to $1 billion market cap and upwards. So that's the sort of stock that I'm talking about. So what I'm looking for is they must be able to grow independent of the macro environment. So that's my fundamental position. I believe firmly that a general market exposure, so you own the banks, you own Telstra, you own Wesfarmers, you own all those sort of stocks. A general diverse market exposure, I believe, is likely to produce a poor return. It hasn't produced a very flash return in the last 5 years when our economy's been expanding. So to me, it's unrealistic to expect something different when our economy is at risk of tipping into recession, or at least a lengthy period of very slow growth. I just think that's not realistic. So these are the key criteria at a big picture level, and the sort of opportunities that I'm looking at span technology, spans mining, energy, industrials. So it's across the board. But these are the overriding key criteria for big winners. You've got to give them a year or two, but big winners, and I'm talking about hundreds of percent gains, and with a high degree of predictability around that as well. This is not punting, this is investing in really good quality businesses that are highly likely to grow. So these are the criteria. They've got to be at the start of a very long runway for growth. So we're talking, absolute minimum 5 years, in fact, really 10 years, 20 years kind of growth runway. That's the sort of thing you should be looking for. They've got to be in a sector where the market is huge, and the market is growing, and that growth is almost certain. Now, nothing is certain in life, but it's got to be almost certain, and that comes from companies that are technical disruptors these days, or that are tying into major changes in society in how we go about things. So disruption in how business is basically conducted, and major changes in society, demographics, etc. So that's where the almost certain market growth comes from. And the companies don't, or really can't be, the biggest players in that sector, because a lot of that growth will already be there. So you've got to find companies that have only got a relatively small market share, but are poised to capture a significant part of that market over time. And the third element you need, and this is critical for any company, is you need the right management team to drive it all. If you don't have a team that's done it before successfully in that industry, then it's so much harder. So the right management team is absolutely critical. Now, turning to precious metals, gold higher by $5 in the end, but quite a nice turnaround Friday, and so far that support zone has held firm. GDX still in medium-term uptrend, as we've seen, and the signs are quite good there. Copper slipped a little bit. Crude oil rose a little bit, so not a lot of change. That 55 level is proving to be a good support. As I indicated last week, the momentum is really in the big stocks, the integrated majors, and the pipeline stocks is where the upward momentum is. There's our spot copper chart, crude oil, and let's wrap it up now with just some final thoughts. I get accused of being a bit of a permanent bullish person, but I believe that one has to start with an optimistic view of the future. I think if that's not your default position, I think you've got no chance in the stock market and probably in life in general. So you've got to have an optimistic view of the future. And if you think back, those that are old enough to think back 30 years, 40 years, how much better we are off now than we were then. I'd encourage the younger viewers of this video just to compare your lifestyle and general position compared to, say, your grandparents, and ask yourself, are you better off or worse off than they were? And I think the resounding answer you'll get is that you're far better off. So I think we all have to start with an optimistic view of the future. If you don't have that, I don't believe you could have made any money in the last 10 years, because you would have just been scared out of your pants every time something came along, the market went down a bit. So I think that's a really important mental state to hold. And then you just need to massage your exposure and your approach according to shifts in the general environment. Now, yeah, sure, we're going to get bear markets that are going to last for 6, 12, 18 months. So you can't just hold that exposure throughout the cycle. That's not appropriate. But you don't need to be all in or all out either. You can move your exposure around in terms of percentage. You can move around your exposure according to what sectors are likely to be the outperformers. So you just need to be on top of that. It's absolutely vital that you've got clarity about your process, because that's what's going to get you through the volatility. if you're clear about what you're doing, that's going to stop you panicking and selling out when it's not the right time to do so, and it's going to help you get back into stocks when the appropriate time comes. And members will know that we did a lot of buying in. We started in late December, and we did a lot of buying in the first week or two of January because that's when the opportunity was. But you needed to be very clear about what you were doing to pull the trigger, because a lot of people were pretty scared at that stage. Portfolio analyst this week, it's really just about more high conviction opportunities. I mean, that's my current mission, is to identify opportunities that have got the sort of characteristics that I outlined a few slides ago, and where we can get an entry where the downside should be relatively short term and relatively limited if it occurs at all. So that's wrapping it up. There's my contact details for anyone who's not a member that wants to communicate with me. And as I said, look out for that video that will come through the week. I think you'll see some real value in that. That's it for this week. Cheers.